Picture this. From 2006 to 2012, the U.S. went through its most devastating housing slump since the Great Depression. This event didn't just alter the nation, it sent shockwaves worldwide, sparking a severe recession far beyond America's borders. Now, we all know the crash itself gets a lot of attention from historians, analysts, and even filmmakers. But what about the years leading up to the downturn? That's what we call the bubble era. It was a time when U.S. home prices steadily climbed, only to explode after 2002. Real estate turned into the heart of the modern-day gold rush, with prices surging daily, leaving buyers scratching their heads in frustration and disbelief. And if this is giving you déjà vu, trust me, you're not alone. Many of us have noticed the market's slow climb after the 2012 crash, followed by an explosive surge after the wild events of 2020. This market is anything but ordinary. Right now, we're in the midst of a brand new bubble. It is no secret that this industry has become anything but normal, with the market experiencing a new bubble. The current state of the market is a stage marked by speculation, investment, and greed. The majority of the public is now well aware that this market has entered the final stages, and it's only a matter of time before it all comes crashing down. The prices of properties have reached a point where affordability has become a major issue. This price hike has been driven by various factors, including low interest rates, foreign investments, and the desire for individuals to own property. In addition, government policies that have facilitated easy access to credit have also played a role. And before we tell you what Warren Buffett has to say about the forthcoming housing crash, please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe is fuel for the algorithm, and I would greatly appreciate your help. Thank you. Now, back to what I was saying. At the Berkshire annual meeting in 2006, Warren Buffett was asked about the status of the residential real estate market and whether he thought it was in a bubble. With economic apprehension running high, whether the market was in a bubble seemed plausible. Remarkably, the response provided by Buffett at that time bears intriguing parallels to the current state of affairs in the United States. The property market has always been subjected to fluctuations with varying dynamics. However, in 2006, economists and investors had a clear sense of unease. In light of this, when asked about his thoughts on a potential real estate bubble, Buffett delivered a noteworthy response then and remains so even now. Fast forward to the present, and it appears that the United States is yet again experiencing a residential real estate market surge. In light of this, the words of Buffett from the past are particularly pertinent today. Before the recent market crash, numerous individuals, including prominent investors and ordinary citizens, were sounding the alarm bells about an impending housing market crisis, the likes of which were previously unseen. Warren Buffett, widely regarded as the world's preeminent investor, was one of the people who recognized the underlying weaknesses in the market. Contrary to the popular notion of a thriving industry, many individuals thought the housing market was precariously on the brink of collapse. These insights and forewarnings were based on astute observations of market conditions, patterns, and trends. Consequently, these individuals sought to caution others about the looming doom, which, in hindsight, was a prophecy that proved to be true. According to Warren, the real estate market follows the principle of the law of the vital few, which is fundamentally different from the stock market. This is because stocks trade live on a daily basis, providing a constant and dynamic market analysis. The current state of the real estate market seems fragile for investors with high-end properties, as they are more susceptible to experiencing the steepest drops in value. This is primarily due to a greater likelihood of purchasing them for investment or speculation instead of the traditional buying for living methodology. In such cases, the owners utilize huge sums of money to acquire these properties, then mortgage them for several times the initial purchase amount, typically hoping to make a profit in the long run. However, in the event of a decrease in the property value, these investments undergo devaluation, leading to significant financial losses. While this scenario may not pose a significant issue for property owners who purchased houses for personal use, with a stable source of income and the potential to continue living there for an extended period, it is a significant concern for those with investment-type holdings, particularly with rapidly fluctuating market values. The result is a market filled with speculators and day traders who buy and sell properties like stocks, leading to significant market movements. On the other hand, the real estate market primarily relies on comparable transactions, which can be limited to only a few properties. This poses a significant limitation, as you may think your home is worth a certain value merely because a similar house down the street sold for a certain price a few months ago. But this approach has severe limitations. Such a limited approach could lead to massive fluctuations in value, which can fall or rise suddenly and without warning. In particular, a few unfavorable sales can significantly impact the value and pricing of an entire neighborhood. This is why housing market crashes are sometimes sudden and unexpected, since a few sales can begin to reprice a whole area, leading to a chain reaction that could lead to an even more significant market correction. Warren highlights the significance of a single buyer for the investors, as this buyer can keep an entire neighborhood financially afloat by purchasing at their offered price. However, in a downturn, the investors react quickly and pull out their investments, causing a rapid decline in real estate prices. This springboard effect can be observed in multiple markets, particularly during the housing crisis in 2007. To illustrate the consequences of this dynamic, we can examine the case of Phoenix. In this city, there were months when house prices plummeted by over 5%, causing a staggering loss of value of $15,000 within just 30 days for a house worth $300,000. Moreover, during the dark days of 2008, the average house price dropped by a shocking 37% in just 1 year, from March 2008 to March 2009. Conversations with agents and investors operating at the time reveal that some areas were hit particularly hard, with many homes losing over 60% of their value in a year. This marked decrease in value was a massive financial blow to those who had invested in these properties and the wider community as a whole. The downfall of the Phoenix housing market was largely attributed to a bubble-like behavior characterized by rapid price escalation followed by a sudden, catastrophic crash. A root cause of this behavior was the prevalence of irresponsible lending to individuals driven by greed rather than sound financial decisions. This reckless lending ultimately fueled a speculative frenzy, leading to an imbalance between supply and demand, culminating in a swift market correction. This drastic example showcases how fragile and unpredictable the real estate market can be. The housing crisis in 2007 was a wake-up call for investors and buyers, reminding them of the importance of stability and sustainable growth in the market rather than short-term gains and erratic fluctuations. According to Warren, the real estate market had been transformed into a penny stock market by investors, exploiting leverage and focusing on quick sales, akin to day trading on their computers. This trend is evident in recent data showing a rapid increase in investor activity over the past 2 years, with many investors resorting to speculative funding methods that are not being reported. These methods include high-risk loans and dubious financial practices that may be fraudulent. Warren's observations highlight the worrying trend of investors prioritizing short-term gains over long-term viability, which could have a far-reaching consequence for the real estate market and the wider economy. Stakeholders must take this issue seriously and adopt measures that promote responsible investment practices, transparency, and regulatory compliance. Warren provides a comprehensive analysis of the potential hazards in the real estate market. He accurately notes that the blame lies not with the common people, but with the greedy real estate investors who employ risky leveraging and greed as a means to their ends. Warren had foreseen that such a lethal mix would inevitably result in a catastrophe. Property values in New York have experienced an alarming fluctuation over the past 3 decades. These swings have been substantial, occurring on multiple occasions, and have contributed considerably to the broader instability issue in the real estate market. Nonetheless, it is worth noting that while the market stagnates initially, it typically rebounds eventually, providing a glimmer of hope to those who wish to sell their investments. The soaring prices of real estate across the country have been largely financed by bad loans issued to speculative investors. This precarious scenario propels the market bubble, which has been steadily growing over the past few years. However, as is often the case with such speculative booms, the eventual downturn will likely be sudden and violent. One of the biggest challenges with housing crashes is that they don't unfold gradually. When the market turns, prices can plummet rapidly, leaving many homeowners and investors in financial limbo. This can be a trying and miserable experience, particularly for those who have invested large sums of money. There are numerous cases of investors obtaining loans to acquire Airbnb properties struggling to make profits, unprofitable ventures, and rental properties characterized by negative cash flow. Interestingly, this trend is not novel, as observed before in a previous Berkshire conference. The situation appears to be ongoing as investors continue to explore the property market with a keen interest in these properties despite the associated risks. This could be due to the perceived potential for immense returns on investment or the belief that such properties can be turned around with careful management and strategic planning. Developers strive to acquire as much funding as possible from lending institutions to bring their visions to life. As a result, we are witnessing a bubble forming that resembles the one that emerged in the early 2000s. While the current conditions may differ from past ones, history has shown that similar patterns tend to repeat themselves in the market. Therefore, it is imperative to remain vigilant and keenly observe the unfolding events, as they may have long-lasting consequences for the industry. Thanks for watching, and please make sure you subscribe if you enjoyed the video and leave a comment below telling me about the things you are seeing in your local market.